Hey, everybody. Finance 3303, Financial Institutions, Chapter 6, Money Markets. So, guys, this is kind of a short chapter, and you're going to see some calculations in here. And I'm not so worried about that with, how to calculate the yield and things. And this is kind of it's part of a group, debt security markets, that I'm taking all under kind of one umbrella. So we have chapter 6 is money markets, and then we have more important ones in my mind, bond markets and bond valuation is chapter 7 and 8, and mortgage markets, which I think is a more important one for this course, chapter 9. So this is, I'm going to show you some things, and I'll point out what's important, what I think is important, especially for our use. Guys, the money markets, if you ever heard of somebody, oh, I got a money market account at the bank, you might have one. Somebody within listening to the video might have one. And what that really means is the bank is um, they taken avail themselves of some of these products that I'm going to show you that wouldn't be for people. They're just for the financial institutions. And they were able to, by large purchases, large dollar purchases, do something that a person couldn't. So the money markets that I've been familiar with, the money market accounts, back when I was more you all's age, when I was an undergrad, the banks would say, which I mean, it's been a long time, but so they would say, well, you got to have a minimum balance of several $1,000s, and they give you a checkbook to write with it. We didn't have debit cards back then. And it was you can't write out small checks. The minimum amount of the check would be $1,000. And what they were trying to do is gather up people with some extra money, and they could put this money together and go buy the things that I'm about to talk about. And they didn't want the person paying their cell phone bill with the checks or their light bill. It was made to move more substantial money around. And it wasn't like in the millions, but it was definitely in the thousands. So the money markets are what surrounds financial institution, and they can take advantage of, like I mentioned before, certain products that you and I can't. So let's scroll up without further ado. Let me scroll up and just show you what this is. So I'm going to leave that for a second. I'll take a picture of that if you choose to read it. But what I'm interested in is these bulleted items. So let me, I could just talk about them from here and then flip through the chapter. You're going to see the calculations, which again, just reiterating, I'm not so worried about. But it's, from a conversation standpoint, is all I'd want you to know about these money market type of instruments. So treasury bills, I've known people to buy those for themselves, and I think through other classes you might understand a treasury bill is a short-term federal government investment. And they're usually out from 3 to 12 months, or T-bills. And the government uses that to finance the majority of the debt of the United States. So that's a federal government instrument. People buy it by the wagon loads, the wealthy people or corporations. And a lot of people would say, well, what does Microsoft do? What does Apple do? They got billions, they got tens of billions. Apple might have 100 billion basically liquid in their checking account. Well, I'll say proverbially in a checking account, what's in some investment account with somebody. And what they're doing is they're keeping that money liquid to the extent that they feel like they have to pay their bills and whatever else they have going on strategically. We're going to build a new building. We're going to build a new, computer center, whatever's going on. We need that money liquid to be turned over periodically, routinely. And we can't take somebody in that position, like in Treasury for Apple, they would say, well, we're not going to take any credit risk in the portfolio. So they buy T-bills. And first of all, they're available if you wanted to buy $100 million of T-bills. You might run out of runway if you're going to a regular bank and you're trying to move that kind of money. So they're way past that. It's you see in here where it says, corporations issue money market securities to finance their operations. So it's short-term type of money to be turned over. So, for people that are very wealthy, the Bill Gates of the world, the Elon Musk, they have people that work just for them to turn these T-bills over. They might buy them, they might buy one today that's maturing in a week. They might buy another one or batches of them that matures in 2 weeks. They'll buy a third batch that matures in 3 weeks, going out for a couple of months. And always you have some maturities coming up. When the maturity comes up, they're either using the money or they're moving it out on the ladder, what's called the ladder, and we'll see that in another chapter. But they're laddering out the maturities where every time they turn around, something is maturing. And of course, the federal government pays interest on those, and there's no default risk at all. So that's where you got an appetite from all over planet Earth of entities, other governments, other countries are wanting to buy T-bills. And that's the majority. What is our debt right now? 37 trillion. That's the majority of the debt is made up of those. So that fits very well into a money market type of environment where, again, I could take $1,000 from several customers or two or 10 or 50, and I could buy some T-bills on their behalf. And then I can share that rate of return with them. So the person that has a money market account at a bank earns more than just about any of their other accounts because they're sharing a larger amount of money and they have constraints on the account that encourages them to keep the money in the bank, in the money market account. So that's what keeps that process going. And it's kind of for wealthier people, and not Elon Musk wealthy. It's just wealthier people within the bank, people that could put 10,000, 100,000 on the side, and they don't need it for a while, and then they just put it at a money market account. I'll pick on somebody like the Whitney, but okay, just going down this bullet point, and I'll explain them, and I'll flip through, and we could see some. It'll be captured on the recording, and then y'all could look at it on YouTube. Okay, commercial paper. So guys, that's usually, I remember seeing in the Wall Street Journal that they used to print, I don't know if they do it anymore, they would see all the commercial paper issuances. And that's a corporate IOU. And General Electric was a huge user of commercial paper. And you'd be surprised that some of these big corporations, they're like, well, I got a major payroll coming up. I need, $35 million to make this payroll at the end of the week. And we might not be getting paid on something that we thought, or you've got a circumstance where we're just in some need of some short-term liquidity, or I've got to pay people by Friday and I'm getting paid ourselves from things that we sold or operations that we had or other products that we have. We're getting paid early next week. So they will float, meaning issue commercial paper, usually, $100,000 or $1 million minimum balances, and they're just selling that out to the market. And of course, they'll pay interest on it, but it might be anywhere, from a couple of days to out 9 months. I think 9 months is the maximum, 270 days. And that's just, General Electric saying, here, buy this for $100,000. It'll be out for a week. I'll pay you interest on it at the going rate, and next week I'll pay you off. So you had other corporations, you had a lot of institutions that would buy commercial paper for that reason. It's a way to pick up a little extra yield. You loan in money to a big corporation. You do have to worry about credit risk because in theory the company could file for bankruptcy or something else could happen, and then you're a creditor. But it's not free of default risk. It's just by the biggest corporations that are issuing that. I've never seen a piece of commercial paper. Had never held one in my hand personally. It would be Fortune 500 companies are doing that. And during the credit crisis, I'll just add this, not to go back too far in history, but that was running afoul. People were very concerned about buying commercial paper from corporations because the economy was in such a deep recession, and there is default risk there. So the commercial paper market pretty much dried up during a couple of years of that period where people were really, really suspicious about what the financial wherewithal of some of these companies that would routinely borrow money this way. But it's kind of a neat thing. Now, back to, from a money market standpoint, a large bank could buy some commercial paper. They might be limited to that because the government doesn't, like the FDIC and so on. They don't like taking unnecessary credit risk, and there might be some that the largest banks might buy some of this from corporations if it makes financial sense for them to do it. Meaning, that, the General Electrics of the world or the Googles of the world are floating some of the paper and they're paying enough to justify the purchase. So that might be a short-term investment. We might not go, anywhere from 2 days out to 2 months, and we're not going to lend very long. And then we want to pay the commercial paper to pay itself off. So that's all that is. But you might never heard of such a thing, and that's what they are. On negotiable certificates of deposit. So first of all, if we know what a CD is, you and I could go into a financial institution, buy a CD. They'll have the rates. You could look it up on their website. They'll have maybe a 3-month CD, a 6-month, 12, 18, 24, all the way out to usually a max is 5 years. And what are we doing? We are making a deposit, purchasing a certificate at the bank. We'll pick on the Whitney again for 3 years, and then they give us a much better rate than usually any of their other products. So you and I have, put that deposit with the Whitney, and they pay us interest along the way. And at the end of 3 years, your principal is coming out, and it could be reinvested maybe in another CD, or you're doing something else with the money. And that's a very old product for banks, and people have been using CDs for a long time. What the book is talking about here is negotiable certificates. So I am way familiar with that market in my banking career. We use a lot of those to backstop some liquidity needs. And so you never know what's going to happen tomorrow. Something could be happening that stresses liquidity. Like you could have a lot of loan demand. You could have a hurricane coming through and a lot of people are withdrawing money. A lot of things could be going on to stress your liquidity. So on negotiable certificates, banks trade those, and we wouldn't even be able to trade our certificate within the bank or to another bank. But if I'm looking for liquidity and say, well, I've got something coming up, and we're doing a loan promotion, and the housing market is doing very well right now. We're making a lot of house loans that tend to be larger amounts, and my deposit base might be stressed. Well, I could call buddy banks and say, why don't you put a certificate on deposit with me? Or you can go to services, which we do, and we said, I need $25 million. And it's like, okay, it'll be there. We'll start putting the money in, and we'll go out and find the banks all over the country. And it's all FDIC insured, so nobody's taking credit risk there. And all of a sudden we get a wire for all that money. It might come in a couple of different wires, or it might come all at once. But then you're just paying the banks, wherever that money's coming from, you're paying the corresponding bank a rate for that certificate. And when it matures, the money obviously goes back to them. But it might be a bank in California, it might be in Kentucky, it might be in Utah, anywhere in the country. But those negotiable certificates, that's what that is. It's like a tradable certificate, which is very unusual because normally when you're thinking of certificates, it's a very modest product. It's not sexy at all. It's just usually stuff that people will get, and it's on deposit at one place for a period of time. But that's it. All right, reverse purchase or repurchase agreements or reverse purchase agreements. Those are popular with the Fed. And again, from a liquidity standpoint or an investment standpoint, if I needed $20 million, I could call the Fed and say, I'm going to send you some investments to use as collateral, and you send me cash. And the Fed will say, okay, well, we're going to do this on a repo, a reverse purchase. And it's like, how long do you think you need the money? I think I need the money a month. Okay, well, then we'll time it to where at the end of the month, the idea would be I'm going to send the money back to the Fed, and they're going to send my bonds or the investments back to me. And the Fed will normally say, we're not going to take any type of collateral. We might take treasury bills because we know that's an instrument of the government. Or we might take some other types of, we might take your mortgages, okay, that put on collateral. Now, if they're taking something that's not like T-bills, the Fed will say, well, how much money you need? I need $20 million. Okay, send me 30 million of investments, mortgages, bonds that you have, and we will float the 20 million to you, but we need plenty collateral because we don't want to have any problems with that. So the repurchase is that the transaction flows in a circle. I will get the money, I'll use the money, and at some pre-planned point in the future, I've got to give that money back to the Fed. Now, I can renew it just to say, okay, I owe you the money tomorrow, but can we extend this out another month? And then you go into the negotiation with the Fed branch and you figure out what, has interest rates changed? What are they going to charge me for the money? Can I get money more cheaply elsewhere? But it's just another, guys, this whole thing is another bullet point for financial institutions that I'm keeping this screen here, that is usually liquidity. For some reason or another, you need money. And it's like your own depositors, your own customers haven't deposited enough for other activities that you're doing. And it could be a sundry of things. It's, we can make money. If I could borrow money from one of these sources cheaply enough, I could invest it. I could do what's called an arbitrage, that I can invest it in loans to my customers. I could buy loans from another institution, and I'm gonna make a spread on that. So it's like, okay, well, first I need the money, and it could come from any of these sources, and then I would buy those loans, and you would have to match it off. Meaning, if you're going to buy car loans that are out there for 5 years, a repurchase agreement normally wouldn't last that long. So you'd have to keep renewing it, and you might take some credit risk. I mean, not credit risk, excuse me, interest rate risk, because in the 5 years, what could happen? Well, interest rates could change on you, and you're not going to get paid more in the car loans that you bought, but you would have to pay more for the money that you're borrowing from one of these sources. So it's management. You have to worry about, well, how much interest rate risk am I taking? In the case of commercial paper, you'd have interest rate risk, but you'd also have what? You'd also have default risk or credit risk, because you'd be worried about, what's the company, what's going to happen there, if you need money from them. What are they going to charge you if you were the issuer of commercial paper? Okay, federal funds. The Fed funds market is a large one, and let's make sure that came from our Fed chapters, I'm remembering, but that's the rate on overnight loans from one bank to another. So just about every financial institution of any size has a Fed funds account. And where I used to work, it's not in the job I have now, it was a previous institution, and it's like we had a large deposit, or there was a bank in New Orleans called Hibernia. It was one of the larger banks. And it's like, well, okay, we want to open an account with you to put our extra money. And the person said at first, oh, well, we have good rates. And it's like, good. So when money is kind of sitting idle, I'm going to put it with a checking account with you all, or some type of transaction account. Well, I didn't know it at first. Little ways down the road, I found out that I was making a loan to them. They put it in a Fed funds account. So what does that mean? It has no insurance because it's a loan. It's not a deposit. So it's like the balance changed every day because we used it every day. We had deposits to make and we had withdrawals to make, and it was all on Fed funds. And no wonder why the rate was good, because they had credit risk. We were worried about Hibernia if it ever went out of business. FDIC is not coming in and paying me the $250,000. The balance was higher than that. But they Fed fund, it was in essence one financial institution loaning money to the other. So they had a lot of Fed funds accounts through their corporate customers. And you just have to be careful if that's what it was. Some people might not have realized it. I was one of them. I didn't realize it was in a Fed funds capacity till, we went down a little bit down the road, and it was like, well, it's okay, but I need to treat this a little bit differently. I might lower the balance. I might move the money around. I might not take on so much credit risk. I might put it in other institutions, not in a Fed funds account. I could buy CDs at Hibernia, and they would be all insured up to the 250,000. Okay, bankers acceptance. That's kind of I've never seen one being done, but I know what it is. And where people are worried about what's called counterparty risk is, let's pretend I'm buying a car from you, and I say, well, I like your car, I like everything about it. Look, let me give you, and you're selling it for 20,000. I think it's a good price. 20,000 is fine, and I agree to buy your car. Let me give you a check. And I I'm a car guy, so I've done this a lot in my life, and you don't normally accept a check from somebody. The check could bounce. Well, okay, so then you could get cash and do the transaction that way, and each person would be just as happy. But what I've done is I've bought cars from out of town. So there was one in Maine, a car that I was buying, and it's like, now what? Am I going to wire up the money? And he wants to make sure he's getting paid before he lets the car go into the trailer, because you'd have to send a trailer up there to get the money, get the car. So you're at a stalemate because I'm saying, well, I'm not wiring the money up. I might not hear from you again. This might be a scam. And then you're keeping my money and then you're keeping the car if the car even exists. So what, and especially, what if you're buying something from Japan? Well, then a bank would stand in and it's the bank would accept the transaction and stand in and pay when the time was right to pay. And I've never used a banker's acceptance per se, but I've used a foreign bank, a place where I'm, let's say, buying the car in Maine. I would say, well, look, I am going to wire the money to you, bank. And usually you could call I could call somebody on the phone because then it's coming from one institution to the other. And then when I'm sure that the car is going to be on the trailer and it could be verified, then you can turn the money loose to the seller. And so a local bank is standing in for me, but it keeps the transaction clean so that neither the buyer or the seller is worried about what's called counterparty risk and worried about what the other person is doing. So you don't want there to be any problems. You don't want to get involved in a scam. You don't want to lose your money, and they don't want to lose their asset. So that's where that's kind of what a banker's acceptance is. And they would stamp a transaction like accepted, and then it would stand in for the usually for the purchaser to move that money to the seller of whatever you're talking about. So there's a lot of international transactions that a banker's acceptance would be the way to go. But again, the bank charges you a little money depending on who it is. And guys, you're seeing just from these explanations, you and I wouldn't have, we couldn't get involved in these things. These are from institutions. You and I are not going to go, even if we're wealthy people, you're not going to go to the Fed and engineer a repurchase agreement. They're not going to do it with a person. It would have to be usually another financial institution. That's the only ones that could be members of the Fed. General Motors can't be a member of the Fed. They have to go through, somebody else to do that because they just, the Fed is the central bank of the country, and they do their business through other financial institutions, basically other member banks. So that's where some of these things get a little bit more specific. All right, so we ran those down. That's easy. Let me just go through some of this. And all right, we don't have, here's T-bills. I'm going to let this right here and let that picture inside of the recording. You could play it back later. Here's where I was talking about the pricing of the T-bills and doing the math to see what the yield is. We're not doing that this semester or any semester in 3303, but I could let this be part of the picture if anybody's so inclined to be interested in that. Estimating Treasury bill discount because they sold at a discount from par. That's what they're saying here. Treasury bill auctions. That's when the government is raising money, they're auctioning off T-bills to other financial institutions. Because the government's got to raise their money and they got to pay interest as well. All right, here's our commercial paper. They're saying, let me write on this. Say that, $100,000, but the typical denominations are in multiples of 1 million because they're not, General Electric is not fooling with $1,000 purchases or anything. So they say 20 and 45 days could be as short as 1 day. Okay, that's the way that IOU could say, I need the money today and I'll pay you back tomorrow because I'm getting paid through some other job. And as long as 270 days, I was remembering correctly there. So it's out there for what is that, 9 months? And then that's got to be the transaction has to be unwound, meaning everybody's got to pay itself off. So like I was saying, sorry, we got to worry about credit risk because commercial paper is issued by corporations that are susceptible to business failure. Commercial paper is subject to credit risk. So we need to remember that for that product. All right, credit risk ratings. We kind of know it's like the bond ratings, similar. Is Moody's, is Standard and Poor's and Fitch. You do not need to know those, but they have their own credit ratings because you could be borrowing money from General Electric, which always had very high credit ratings. So you could be borrowing from General Motors that have had terrible credit ratings at some time. So that would make a difference where they would have to pay up, right? General Motors would have to pay more interest than General Electric because their paper isn't as good as General Electric. So you see in here, using bond market language, the stylus will tell me it's going up. It's called junk commercial paper. Okay, so that's low quality commercial paper written by other institutions. Okay. All right, estimating yield, not to worry about that. Commercial paper yield curve, it would have its own yield curve based on this product that's kind of unique to the largest corporations. Um, and it would be a yield curve that, it's upwardly sloping from left to right. This is a commercial paper rate over time, so it follows a lot of the Fed funds. But of course, Fed funds are the funds that exchange between banks, and commercial paper, again, just reminding us, is usually by corporations. Okay, here's your negotiable CDs, and you see in where it's denominations, 100,000 through a million. Um, that's because institutions are trading these, and you and I are not. So they would have the FDIC insurance, but only up to the 250. Okay, repurchase. Let me get that to where it's captured in the recording. Um, it was saying, guys, just to quote this, financial institutions such as bank savings and loans and money market funds often participate. Many non-financial institutions are active participants. Society, they're not doing it with the Fed, but the size of the repo market is $4.5 trillion. So that, it's a lot of money out there. And what are people doing? What is the whole point? I want to make sure we understand that it's usually people that need the liquidity and put up the sufficient amount of collateral to cover it. Because the person loaning you the money or wiring you the money doesn't want to have to be worried about, well, it comes up for you to pay them back. Well, I can't do it. I ran into a problem. They don't want to hear about any of that. They want that it's very rigid. They want that trade to properly unwind. So that's why in the Fed's case, I was just working like this week. I was working with the guy at the Atlanta Fed. We had securities on deposit with them to establish a credit line. It would be like a reverse or repo. And you see where it says a reverse repo right here. And periodically, I was on the phone with him for about an hour. Okay, we want to let me read back all of the securities that we have with you to establish this credit line, and they will refreshen that from time to time because you'll have maybe short-term bonds that'll mature, and okay, then the money comes back to me, but that was collateral at the Fed. So that's, it's a time you get on the phone with them and okay, well, let's see where the portfolio is and let's see what's going on. And you just kind of rebalance things. But the repo market, is big at the Federal Reserve. All right. Wall Street Journal key interest rates. You don't have to know this, but just this is how it would look. You see Fed funds there in the upper left. And then underneath that, I mean, this is probably some time ago. When is this? I can't see what a date is. Not that that's so important. Let's see something. January 2011. Okay, so you got treasury yields, you got interest rate swaps, something that's a whole nother chapter in our book. But you have commercial paper in the upper left, and it just shows what the interest rates are. Um, yeah, for whoever is going to engage in those transactions. Right, Fed funds. All right, so the Fed funds market enables depository institutions to lend or borrow short term from each other in the so-called Fed funds rate. So again, it's the interest on loans from one bank to the other. And the language that's normally used here, it's on overnight loans, meaning that the Fed funds rate could change every day. So it's if I call one of my buddy banks and say, well, look, I just need some Fed funds, just deposit $1 million with me. And let's say they quote this, okay, the rate is 4%, and they call me tomorrow. It's like, you giving me my money back? No, I still need it. That's okay. But today's rate is 4.05. And tomorrow's rate might be, 3.99 or whatever it is. So it's treated as an overnight loan that the interest rate could change every day. You're not locking it in. It's completely fluid. And if I don't like what they're doing, I could just send them their money back and that would be the end of it. So it would be paying off that loan that I have with them. But again, it's the rate. Federal funds is the overnight loan from one bank to the other, but the Fed funds rate is the rate of that loan, charged usually on a daily basis. Okay. Says here, commercial banks are the most active participants in the Fed funds market. Fed funds brokers serve as financial intermediaries, matching up institutions. Like I had mentioned, we have people that'll do that for us that wish to sell or lend funds with those that wish to purchase or borrow them. So, you don't have to call and I know several bankers locally, and I could call them directly, and that they wouldn't be surprised at that. But usually, a lot of people would just go out to a service where they could be borrowing or getting you money from all over the country. So you're not sitting there at your own desk doing that. They of course charge you a small fee for it. Okay, here's your banker's acceptance, and I think this is the last one. I told you it was a quick video. Banker's acceptance indicates that a bank accepts responsibility for a future payment. There you go. Same thing with the car I bought in Maine. They're going to accept responsibility for that. They will make sure that everything is happening properly before they go ahead and make the payment. But they're local. In my case, they were local and they were on hand and they could put their eyes on what was going on. And I couldn't see very well from here to Maine. So that worked out. That worked out well. That type of stuff, a financial institution might be willing to stand in for you, but it's subject from one financial institution to another. But that's what a banker's acceptance is. So let me scroll up. So guys, all we need to do, scroll up to get this in the recording. All we need to do here is you don't have to know that diagram. Let me see one more thing. All we need to know is conversationally what I've done with this chapter. Okay, so here's a valuation of money market. This is just the present value of the par. That's what this is. The present value at the denominator of the par value. So, if anything's due in the future, we know because we're finance students, we know we would take the present value back. But again, no calculations on this. I'm not interested in that. It would just be understand if I'm asking you what uh, the repo agreement is, if you could just tell me casually in words, not calculations, what that is, that's all I want you to know here. All right, let's see. They're going back to Lehman. That was the largest bankruptcy in the history of the United States. Lehman Brothers was, I think, a multi-trillion-dollar firm that went bankrupt in the recession of 08, 09, and that was a big deal. You're seeing right here, so as Lehman Brothers filed for bankruptcy in September 08, it defaulted on hundreds of millions of dollars of commercial paper it issued. And the bankruptcy, when we were studying bankruptcy, this would be a case that, all the people that were holding commercial paper couldn't get paid back. You were then a creditor and fell into that pecking order that we talked about when we were talking about personal bankruptcy. Well, it was a big deal, I promise. Okay, value of commercial paper outstanding over time. See, after 0809, that dropped off. So it's a fraction of what it used to be. But okay, guys, that's all we need here. That's all we need for chapter 6. I'm glad to post that on my YouTube channel, and you'll see it there. And thanks for watching.